Are we on the brink of an economic crisis? Dive into this week's urgent financial updates as we dissect shocking CPI reports, predict severe market crashes, and explore unsettling geopolitical threats.
We've got expert insights that will leave you on the edge of your seat, unpacking whether your financial future is at risk.
Don't miss the inside scoop on how to navigate these volatile times. Like, subscribe, and stay ahead with financial news and review.
Yes, your time-saving guide to understanding stocks, real estate, and the economy. Shall we get started?
Ever wondered how much you need to earn just to live comfortably? Brian Kim reveals startling new figures amidst rising inflation. Jeff Snyder breaks down a bombshell CPI report. Hint, it's not good news for the economy. Peter Grandich warns of a massive market crash and potential civil unrest. What's driving his grim outlook? Michelle McCory highlights a surprising new conflict that could trigger WW3. The setting? The South China Sea. Game of Trades discusses a once-in-a-lifetime financial upheaval and its eerie parallels with the 1970s. Dr. Anna Wong predicts rising unemployment and a recession-like environment. How bad will it get? Welcome to ClearValue Tax on YouTube. Today, we tackle a shocking statistic. Americans believe they need to earn $186,000 a year just to live comfortably. Joining us is the ever-reliable Brian Kim. Get ready for some eye-opening insights.
Absolutely. We're diving into the deep end of financial challenges today. Buckle up.
So, what's the main takeaway from Brian Kim's analysis? Why is this figure so high?
The core thesis is that inflation has driven up the cost of living to such an extent that Americans feel they need $186,000 annually just to live comfortably.
All right, let's break down those key points, starting with the inflated living costs. What's going on there?
Prices have skyrocketed. Houses now cost over $400,000 on average. New cars are $47,000. Everything from groceries to insurance has seen massive hikes.
And about the survey insights, what did we learn?
Even the lowest income required across demographics is $171,000. Meanwhile, the median full-time worker earns just $59,500. No wonder people are financially stressed.
What about the changing definition of financial success?
That's fascinating. People now see financial success as living debt-free and being prepared for future financial obligations rather than amassing large amounts of wealth. It's a stark change.
Time to gaze into the crystal ball. What predictions does Brian make?
He predicts the economic environment will continue to favor those with financial assets due to inflation and high interest rates, likely widening economic inequality.
Wrapping it up, what are the main takeaways?
Brian emphasizes budgeting as crucial, no matter your income, and offers a free budgeting spreadsheet. Plus, he stresses the need for realistic financial strategies given the high cost of living.
Thanks for tuning in. Don't forget to download that free budgeting spreadsheet from Brian's website. Stay smart with your money, and see you next time. Welcome back to Eurodollar University, folks. Today we're diving into a bombshell CPI report that's sending shockwaves across the market. For this segment, we'll distill all the juicy details and what they mean for the economy and your investments.
Absolutely. It's quite the roller coaster. Jeff Snyder breaks down the latest Consumer Price Index report, and let me tell you, it's not just another day, another dollar.
So what's the main shocker in this CPI report? What's really going on?
The core takeaway is that while the report initially seemed like good news with declining prices, it actually signals deeper economic trouble. Basically, 2 months of broad-based disinflation point to a tilting economy heading towards recession.
Let's break down those key points. Broad-based disinflation, you say?
Yes, indeed. For the first time this cycle, consumer prices fell across the board. Not just gasoline, but also services, rent, and auto prices. It's like a supermarket clearance sale, but not one you'll feel good about.
And this isn't just a one-off thing, right?
Correct. 2 consecutive months of declining CPI is rare. Last time we saw this was during the worst lockdowns of 2020, and before that, the oil crash in 2016. Definitely not your usual day at the office.
What's driving this downturn?
Weak consumer spending, rising unemployment, and companies slashing prices because customers are broke. Big names like Target and Walgreens have been saying this for months.
How's the bond market reacting?
Interest rates are diving. The yield curve is doing a dance, particularly in the 5-year and 10-year spreads, which is a big flashing recession ahead sign.
So what's in the crystal ball for us?
More rough patches, I'm afraid. Companies will continue slashing prices as demand weakens. And while the market thinks the Fed should cut rates soon, don't hold your breath. They might wait until September or even later.
Wrapping it all up, what's our big takeaway?
Jeff Snyder's message is clear. This CPI report is a warning sign of deeper economic issues. Forget the Fed's rosy outlook. We need to brace for tougher times and consider genuine, robust economic strategies moving forward.
Welcome to the David Lynn Show on YouTube. Today's episode is a whirlwind of insights and predictions from the ever-insightful Peter Grandich, founder of Grandich & Co. Buckle up, we're covering potential market crashes, geopolitical turmoil, and the bright future of gold.
Absolutely. Grandich brings a wealth of knowledge, predicting everything from social unrest in the U.S. to the possible dissolution of the European Union. Plus, he'll give us the gold scoop. Pun intended.
So, what's the main takeaway from Peter Grandich's latest interview? What's his big claim to fame this time around?
Grandich suggests we're heading for a significant crisis. He predicts social unrest in the U.S., the end of the European Union, and a major market crash. His advice? Tread carefully and invest wisely in precious metals like gold.
Interesting. Let's break that down a bit. What does he say about the market?
Grandich is seriously bearish. He predicts a minor 10% correction soon, but warns of a much more severe 30 to 50% drop over the next 3 to 5 years. Basically, it's going to be a bumpy ride.
Yikes. And what about the geopolitical and social issues?
He's concerned. Drawing from Ray Dalio's insights, he sees the political divide growing and warns of possible civil unrest, maybe even civil war. On top of that, he predicts that nationalism and instability in Europe could spell the end for the European Union.
Okay, we've got the doom and gloom. Let's talk gold. What's his take there?
Grandich is bullish on gold, predicting it could hit between $2,700 and $3,000 per ounce by 2025. He believes it's a reliable investment amidst all this uncertainty.
Gold always seems to glitter in times of trouble. And any other investment advice from Peter?
Definitely. He emphasizes capital preservation over aggressive growth, and he's keen on resources like uranium and copper, especially given their crucial roles in the future energy sector.
Crystal ball time. What specific predictions does Grandich make?
First, a severe market drop of 30 to 50% in the next 3 to 5 years. Second, he foresees civil unrest or worse in the U.S. and predicts the breakup of the European Union. And for a hopeful glimmer, he sees gold's price reaching as high as $3,000 per ounce by 2025.
So, mixed bag there. Wrap it up for us. What's the takeaway from all these insights?
The takeaway is to be cautious and strategic in your investments. Focus on capital preservation and hedge with precious metals. The geopolitical and economic landscape is unstable, and it's better to be prepared than caught off guard.
Thanks for that summary. It sounds like Peter Grandich is urging us to be mindful of our investments, especially in volatile times.
Exactly. He emphasizes financial prudence, diversification, and investing in stable assets like gold to navigate the uncertain future ahead. Solid advice for anyone looking to safeguard their financial well-being.
Welcome to Kitco News on YouTube. Today's hot topic, what could really trigger World War III? Spoiler alert, it's not the Middle East or Russia-Ukraine. We've got Michelle McCory from Kitco to unravel this for us.
Absolutely, the situation is more complex than it seems. The spotlight today is on the South China Sea, a major but often overlooked potential flashpoint. Buckle up.
So Michelle, what's the main takeaway from your latest analysis? What's lurking beneath the headlines?
The crux is that ongoing geopolitical tensions in the South China Sea are incredibly risky. While everyone's talking about the Middle East and Ukraine, it's actually the South China Sea that could drag us into a larger conflict, especially because of mutual defense treaties.
All right, let's break down those key points. Start with the shared global tensions. What's happening?
While the hotspots like the Middle East and Ukraine are well known, rising tensions in the South China Sea are just as dangerous. China asserts extensive claims in this region, which were invalidated by an international tribunal in 2016.
And about the South China Sea conflicts specifically.
We've seen recent clashes between Chinese and Philippine forces. These altercations, like near collisions and physical confrontations, stress the U.S.-Philippines Mutual Defense Treaty and could escalate quickly.
What about the global trade ramifications?
The South China Sea is pivotal for global trade. 44% of maritime container traffic goes through it. Disruptions here could cripple supply chains, leading to skyrocketing inflation and economic instability worldwide.
Time to look into the crystal ball. What predictions are on the table?
First, any further provocations or aggressive maneuvers by China could rapidly escalate into a conflict that activates the U.S.-Philippines Mutual Defense Treaty. Second, even without a full-scale war, continuous skirmishes will lead to massive economic fallout.
Wrapping it up, what are the final takeaways?
We need to maintain strategic awareness. While the world fixates on familiar conflicts, the South China Sea's volatility poses major risks. It's essential for global powers to prepare and mitigate these threats to avoid triggering a larger conflict.
Welcome to Game of Trades on YouTube. Today's episode is a doozy. A once-in-a-lifetime financial event is here. Buckle up, folks. We're talking about inflation waves, past, present, and potentially future.
Absolutely. This episode dives into some serious financial history and draws eerie parallels between the 1970s and today. Get ready for an eye-opening discussion.
So what's the main argument here? Are our wallets in for another beating?
The crux is that we might be facing a second wave of inflation similar to the 1970s. Key metrics like supercore inflation seem stable for now, but the risks are real, and the Federal Reserve's moves will be decisive.
All right, let's break it down. First off, historical context. How bad were those 1970s inflation waves?
Pretty catastrophic. The market dropped 70% over a decade due to 3 devastating waves of inflation. Fast forward to today, we've just had the largest inflation wave since then, causing a 25% market drop in 2022.
Yikes! Now what about this supercore inflation? Sounds like an inflation metric on steroids.
You could say that. Supercore inflation excludes food, energy, and shelter. In March 2024, it saw a 5% increase over 3 months, which is high, but it has since cooled down in April and May.
And how are food and energy prices fitting into this inflation puzzle?
Interestingly, gasoline prices have been mostly on a decline since mid-2022, and oil prices are down over the last 3 months. Food inflation is currently at a reasonable 2%, down from a whopping 11% 2 years ago, so no major alarms there yet.
All right, but what about the stock market? Isn't that the real battleground here?
You bet. The stock market's gyrations are closely tied to Federal Reserve decisions. The Fed has kept rates above 5% since August 2023, and every hint of a rate cut sends the market soaring. It's like watching a financial soap opera.
So what's in the crystal ball? Where do we see the market going?
We might see more upward movement. The equal-weighted S&P 500, RSP, has been lagging behind, but it could catch up and spur another rally. Plus, with core inflation at its lowest in 4 years, there's a chance the Fed might cut rates more aggressively, boosting the market even further.
Closing thoughts. What should we be bracing ourselves for?
The possibility of another significant inflation wave is very real, but current data shows mixed signals. Ultimately, it'll be all eyes on the Fed. Their actions will be the critical factor in shaping what happens next. Hold on to your hats.
Welcome back to Thoughtful Money. Today's juicy topic. Are we on the brink of a recession? The unemployment rate might have something to say about that. Joining the spotlight is Bloomberg's chief U.S. economist, Dr. Anna Wong.
A pleasure to be here. Anna brings a wealth of experience from her time at the Fed, the White House, and the U.S. Treasury. We'll get into why a 4.5% unemployment rate could feel like a recession, even if it's not officially declared one.
All right, let's cut to the chase. What's Anna's main argument here?
The core argument is simple yet impactful. Unemployment will rise to 4.5% by year's end, causing a recession-like atmosphere. Regardless of whether it's officially labeled a recession, most Americans will undeniably feel it.
Time to break down the essential points. What's kicking off the economic turbulence?
We're seeing sluggish GDP growth, 1.4% in Q1 and an estimated 1.5% for Q2. Retail sales for May barely moved the needle at 0.1%, and unemployment is creeping up to 4.1%.
How about geopolitical angles? Anything spicy?
Oh, absolutely. Tensions between the US and China are heating up, especially with the looming presidential election. This could affect major players like Nvidia, which relies heavily on suppliers from Taiwan and Israel, both geopolitical hotspots.
Got it. Now, what's cooking at the Fed's policy kitchen?
Funny you ask. The fiscal and monetary policies seem to be playing a tug of war. Fiscal policies are still stimulating while the Fed tightens the reins with higher interest rates. And heads up, if Trump wins, we could see rate hikes through 2025 and 2026.
Yikes! And what about those job data? Are they truly reliable?
Not exactly. Data inaccuracies mean we're potentially seeing more robust job numbers than reality suggests. This could lead to the Fed making policy choices based on flawed information.
All right, prediction time. What's Anna foreseeing in her crystal ball?
First up, she predicts unemployment will rise to 4.5% by year end, making it feel like a recession for many Americans. And who could blame her? Historically, unemployment spikes are a bad omen.
And what about those Fed rate hikes? Should we brace ourselves?
Definitely. Tariffs and fiscal uncertainties loom large, possibly leading to more aggressive Fed rate hikes in the coming years. Be ready for a wild ride.
Let's wrap it up. What's the essence of Anna's message?
Unemployment hitting 4.5% will send recession-like shivers down most folks' spines. Whether it's officially declared or not, everyday Americans will feel the pinch. Anna stresses the need for thoughtful economic policies to navigate these choppy waters.
In this episode, Brian Kim delves into the harsh reality of inflation, showcasing why Americans now need $186 a year to live comfortably.
Jeff Snyder reveals economic cracks with his analysis of the CPI report, while Peter Grandich warns of severe market drops coupled with geopolitical chaos.
On the geopolitical front, Michelle McCory sheds light on the South China Sea as a potential WB3 trigger, emphasizing the need for strategic awareness.
Finally, Dr. Anna Wong talks about the impending rise in unemployment to 4.5%, which will make it feel like a recession for many.
Despite their diverse perspectives, all experts agree on the challenging road ahead. Stay tuned for more critical insights. Thanks for watching the week's top financial videos in review for July 12th, 2024. If you'd like more time-saving content, please remember to like and subscribe. If you have ideas for more channels you'd like to see summarized, drop a comment below. See you next time.